if HMRC come and say you owe us tax because you're a resident and you've earned this income, if you go, but Governor, I've paid it in Spain, Greece, wherever, they'll be like,
don't care.
That's not my problem.
Welcome to the Tax Compass podcast, navigating UK tax for expats with LSR Partners.
So today we're going to be talking about something that on the face of it sounds pretty dull, double tax treaties. But in fact, they're quite important and they make a big difference for people when they're going backwards and forwards to different countries. And we have a lot of clients who come and speak to us about their tax position. They do a little bit of internet research. They understand that there's something called the Statutory residence test in the UK. And then they panic about what it means. One poor old dear trying to look after her elderly mother, which we'll come on to in a bit. But it's one of those things where it's worth understanding a little bit more about tax treaties because ultimately they can make a real difference and they can cause significant issues at the same time if you don't get it right per the treaties. So what we're going to do here, Laura's going to speak a little bit about generally how the tax treaties work. We're going to do a little bit of a special section on the USA because the USA has their slightly strange taxation methodology of taxing nationals as well as residents. And then to wrap it all together with a few examples of where we've seen it really help people and also we've seen people really run into difficulties. So Laura, do you want to start by just giving us a bit of an overview of what the purpose of double tax treaties is and how they, generally speaking, sort of flow down from the OECD?
So in terms of a double tax treaty, it's fundamentally an agreement between two countries as to how, I suppose, as a starting point, who gets to consider an individual or potentially a company their resident, and dependent upon how an individual or which country gets to claim that they're a resident, it will then also give some guidance in terms of how various sources of income should be taxed between the two countries.
So I guess one of the things with that, right, is that if you're just a standard punter like me, sitting here, living in the UK, maybe a trip abroad to go on holiday, Benidorm or wherever. I'm just a tax resident in the UK and that's all there is to it. But tax treaties really come in, don't they, where you can end up being tax resident in two countries at the same time.
Yeah, so it definitely helps when you're tax resident in multiple countries, in most instances, or alternatively, it will help in instances where you're resident in one country, but you're receiving income or gains from another country, and it will allocate taxing rights or limit taxing rights.
For example, we have clients, don't we, who we have a lot of clients who live in Spain.
Yeah.
UK retirees who get pensions from UK sources because they've basically worked in the UK for their whole working life, then they've retired to Benidorm. And the tax treaty between Spain and the UK would determine who gets to tax those UK pensions or whatever it might be.
Yes, exactly.
That's the sort of easy part of it. I think the thing that we often come up against is situations. I was speaking to a client yesterday who lives in Germany. He also sort of lives in the UK. His employer thinks he works from the UK, but he actually sort of works from Germany. Yeah. And he was very worked up about whether or not he should be a UK tax resident, a non-UK tax resident. And one of the things that was interesting, sort of talking him through the way the system works, is you can end up being resident in both, and then you look at the tax treaty to determine who taxes what.
Yeah.
And then you do the same thing as well, even if you're only resident in one. If in his situation, for example, he was working for a UK employer but working from Germany.
Yeah.
The UK will always have taxing rights when he's in the UK, and then Germany will have taxing rights when he's in Germany. And then it's a question of how you sort that out to make sure you're not being double taxed.
Yes. So I think when it comes to tax residents, and certainly in the UK, we look at the statutory residence test to determine whether you're considered to be UK tax resident or not. And that's regardless of what's going on with any sort of double tax treaties in your tax residence position in another country. And
that's what we term domestically resident, right?
Yes.
And so often we have people, what do you mean by domestically resident? It's that whole thing of saying, Well, you're resident in the UK under the UK's own rules before you've looked at anybody else's rules.
From a UK perspective, you can be considered non-resident by the domestic rules. You can be considered resident by the domestic rules. And then you can, I suppose, be resident per the domestic rules, but then also treaty non-resident in the UK, because per the terms of a double tax treaty, you're actually considered to be tax resident in the other country. And again, looking through potentially a set of tiebreakers, it's determined that you're considered to be treaty resident somewhere else.
So let's just talk a bit about how the so-called tiebreakers work. So step one, when you're looking at treaty residence and where your treaty residence is an assumption that you're resident in two countries.
Not always, because occasionally you can look at it to determine just whether you can use the treaty to provide the relief. And so normally within the residence article, it will start with this is what the criteria of being considered resident means for each particular treaty. And then normally what will happen in terms of that residence article, and I say normally because I know of at least one, the UK-Greece double tax treaty.
Yeah, there are
exceptions.
They follow the OECD often, but then, I mean, the Greek one is, 1953, I think it was brought in, something like that. So it's very old.
Well, that basically says if you are considered tax resident in both countries, disregard the double tax treaty. Yeah. But the majority of them will then have a set of tiebreakers in terms of determining where you are considered to be resident for the analysis of the rest of the treaty. And normally the order will be, where do you have a permanent home available to you? So I suppose it's fairly clear if you have, I don't know, left the UK, sold your home in the UK, you've bought a home in a different country, and you return to the UK only, short term, you stay in Airbnbs when you're there, you don't have any sort of home in the UK, it would be pretty clear cut that your place of residence is the country which you've moved to. But in certain instances, for example, we get quite a few people who maybe have left the UK in order to work outside of the UK, but their families remained in the UK, especially if they're going out to the Middle East. And in those instances, because their family has remained and they've got a permanent home still in the UK, you kind of have to weigh up though, well, do you have a permanent home in the other country as a starting point? Quite often, if you then have a permanent home in both countries, you would then look at where your cultural and economic ties or your centre of vital interests are closer. So again, if you've left the UK and you've taken your family with you, your work is no longer in the UK, it's in a different country. If you've kind of basically cut ties to the UK, then generally the cultural and economic ties are going to be closer to the country you've moved to.
And an interesting one there is that it's important for people to realise that it's not like a one-time decision. It changes. So you could be in that situation, you could leave and have your cultural and economic ties being very much in the UK still. Yeah. We've been helping a client recently, haven't we? Him and his wife are moving to Portugal. At the moment, their economic ties are much closer to the UK, and they're maintaining their home in the UK. But in the future, they expect to, move more of their life over to Portugal. And at some point, you probably look at it and say your economic and cultural ties are probably closer to Portugal. So it's a movable feast. Oh,
definitely. And it's also, I think when we look at, normally we talk about the statutory residence test and how black and white that is. And it's very much about what you have done. And, once you've spent those days in that country, that you can't kind of undo it because, it's black and white. The double tax treaty is a lot more of a grey area, and it's based upon intention. We've seen instances where we've had clients who've left the UK for 12 months. They haven't left the UK for long enough to break residence in the end, but when they left, their intention was it was a permanent relocation. And even though their partner remained in the UK, we were still able, because of the criteria that was the case again, in that particular scenario, we were able to argue successfully. It was through an HMRC inquiry, but we were able to argue that they were in fact treaty resident in the country they'd relocated to, because of the fact that, because their intention was genuinely to move.
They'd even sorted out a license for their pet.
It was, dog vaccinations.
So I guess that's the takeaway from that chunk of it, isn't it? It's like it's a movable thing. It's qualitative rather than quantitative, or rather more qualitative than quantitative, versus, say, the statutory residence test, which really is a box-ticking exercise, and you either do meet the criteria or you don't.
And I suppose the other thing to think about in terms of the double tax treaty analysis is that, I suppose scenario one is, where's your permanent home? If you've got an answer to that, great. You don't have to look further through it. But, it could be with cultural and economic ties. If you've got one foot in one country and one foot in the other country, it may be that it's not possible to determine from that which country you're aligned more closely with, at which stage it then shifts. You then have to look further into it, which quite often is where's your habitual abode. And say, for example, up until, the day that you kind of are relocating, you're spending, as you said, if you've got somebody who's maybe living between the two countries and maybe initially they're spending, 9-10 months of the year in the UK and a couple of months in the other country, and all of a sudden that switches, so it's the other way around, that can sometimes play a part. And then finally, if you still can't kind of tell which country would kind of get to claim you as their resident, you then usually will end up with which countries are you a national of.
Yeah. But that's right at the back end of the analysis, isn't it? It is. And it's very rare that I'd say you generally end up in that situation. Yeah. So that's a bit of an overview as to sort of how tax treaties work. So I guess the key takeaways are, if you do spend time between different countries, it's important to be aware of the fact that there will typically be an agreement between the two governments as to how taxation works for those people, and it's always worth giving it some consideration, because often it can get people out of binds where you actually can, as I say, I think people struggle with this idea that I could spend 250 days. We often get these calls, don't we, where people go, well, I'm a UK tax resident because I've spent 183 days in the UK. And you go, yes, but it might not be quite that simple, because you might be treaty resident somewhere else. And then they go, what does that mean? And I found it weird the first time I really looked into this with a couple who live in the West Midlands. Their child goes to the local school. They spend 250, 300 days or whatever in the UK, and yet they're treaty non-resident. And that sort of feels weird, doesn't it? Because people look at it and go, hang on a minute. Everyone's always told me that if I spend more than 183 days in the UK, I'm resident. And it's like, yes. But then you have to look at the treaty if you're resident in two countries at the same time, and they were tax resident abroad as well. Yeah. And then it was a question of looking at it, wasn't it? To say, actually, yeah, you are treaty resident. But it does sort of mess with your head, because you think, hang on a minute, you're living in the UK and you're driving on the UK roads and all the rest of it, and yet you don't pay any tax here. You're paying it all to some country where you don't live, and it sort of feels weird. But I guess when you look at the overall way that the system is designed to operate, it's sort of all reciprocal. And, much with so many different things between countries, it's sort of, I'll scratch your back if you scratch mine. This is how it works for us. Okay, so we talked a little bit there about the sort of residency side of it. Once you're into tax treaties, I think it's probably worth covering off on the way in which the treaties tend. And look, it's important to point out to people that most tax treaties are modelled on the OECD model tax convention. Yeah. They all have little differences. As I said, we'll come on and talk about the US, which is in some ways more different than most. But when we're talking here, we're just going to talk about, the most common situation, because otherwise we're going to get into the weeds of all sorts of different caveating. So this is just a sort of general view of typically this is how it works. So talking about the different types of income, I think it would be useful to cover employment income, which is relatively straightforward most of the time. Yep. Self-employment income, because I think that whole point around permanent establishment is going to be an interesting one to cover off. And then investment income.
Okay. So in terms of employment income, normally you would tend to see that the taxing rights would go to the country of residence as a general rule of thumb, unless the work is physically exercised, as in if you're physically located in the country when you're doing the work. So we've kind of probably covered it a few times, but in terms of your employment income, it's all irrelevant of where your employer is based. Yes. In general.
So a good example would be, I work for a UK employer. I do that work from the beach in Spain, but it's a UK employer. Surely I pay tax in the UK.
No.
You pay tax in Spain because that's where you're doing the employment, you're exercising it. But if you go and have days back in the UK,
then those days
will be taxed in the UK because you work for a UK employer.
Exactly. And Most, but again, not all. Hence why, if you are thinking about analysing the double tax, or considering double tax treaties, you've got to look at the specific one that applies to your instance. But quite a lot of double tax treaties will have something called a short-term business visitors provision in there, which will basically suggest that if you spend no more than 183 or less than 183 days, it can either be in the tax year or it can be on a rolling 12 month. And again, depends on which double tax treaty you're looking at. And as long as, so let's say you're a non-resident of the UK and we're looking at it from that perspective. So less than 183 days in the UK, your employer is not a UK-based employer, so you're being paid by an employer outside of the UK, and the costs aren't being recharged to a UK-based employer, then effectively...
That's not taxable in the UK.
Yeah, even if you are having UK-based work days, you may find that you're not actually having to pay any tax in the UK.
Which obviously, it makes a lot of sense, right? Because when I used to work in finance, I used to travel all over the place and go and do days' work in all sorts of different countries. But and it's that's obviously different because that's just travel for work. But in those sorts of situations where you are coming backwards and forwards, that sort of makes sense. But then the 183-day provision thing sort of adds that extra flavour of, well, you're actually spending sort of as much time in that country as you are in the sort of home country, as it were.
Yes.
Now, what about self-employment income? How does that work?
So as a starting point, again, if we look at somebody who is a UK tax non-resident, the starting point from a UK tax perspective is that if you're self-employed, you'd only be taxable on work physically undertaken in the UK. But again, most double tax treaties have a business profit section. And what they will tend to say is if you're running a business from outside of the UK and you're making profits outside of the UK, you're not going to be creating a tax obligation in the UK unless the work is being carried out from a permanent establishment within the UK. And in terms of a permanent establishment, I think there's things to be careful of because there are things that could potentially create a permanent establishment, such as, quite often if you've got a proper home in the UK that you're working from regularly, that sort of thing can create a permanent establishment. If you're signing off contracts whilst you're in the UK, that can create a permanent establishment. But it is usually a degree of permanence to create that permanence.
But again, it's a set of tests, isn't it? And it's not black and white. There are things in the treaties, typically in the definitions, where it says these are the things you need to consider. So that's employment and self-employment. Let's talk a little bit about savings income or investment income, because that's an interesting one because it tends to be a bit different between interest and dividends. Yeah.
So again, I would say look at the double tax treaty because different tax treaties have different rules, but quite often when it comes to the interest income, taxing rights will be given to the country of residence rather than the country where the incomes come from. Quite often with dividends, and not always, but quite often with dividends, there is still some taxing provision available in the country where the income's being sourced from, but it's usually limited.
So we'll quite often see 10 or 15% is the maximum tax that the country of sourcing can levy, and then obviously the rest is taxable in the country of residence. Yeah,
and this is where you have to go a little bit careful from a UK tax perspective, because normally what would happen is if you are doing, if you're receiving income from somewhere outside of the UK and you were incurring taxes on that income, then your standard starting approach is, well, I've incurred these taxes in that other country, so I want to claim a tax credit on that, because normally that's the whole basis of the double tax treaties, is to prevent that double taxation. Now, in the difficulty that you sometimes have, I know there are certain countries, for example, where maybe a tax rate of 30% might be applied in terms of
locally withholding, for example.
But when it comes to the double tax treaty and us claiming a tax credit in the UK,
we're capped, aren't we, by the treaty?
Exactly. So if the country where the income's been sourced from is withholding 30%, and we can only claim 15%, in order to prevent that double taxation, you then would need to go back to the country
and try and get a refund in that country, which can create all sorts of issues.
Yes, lots of fun.
So I think the watchword out of the tax treaty is, and we're probably overstressing the point, but always look at the specific tax treaty between the countries that are relevant. Also note that there isn't necessarily a tax treaty with every country. Brazil's an argument. I think they managed to get to a draft one, and it was due to come in under the last government, and now it's been paused.
Yeah. Yes.
So when you are in a country with no tax treaty, that's something to be aware of. Doesn't necessarily mean you're going to be double taxed, but it makes it a little bit more complicated as to how you go about sorting yourself out.
Yeah. A common misconception that we will sometimes come across is that people assume that because there's a double tax treaty in between the UK and the other country
XYZ.
Yeah, then obviously that the whole the whole purpose of the double tax treaty is to prevent double taxation. So because there is a double tax treaty and I am reporting and paying tax in country X,
that's a good point.
I don't have to report it and pay tax on it in the UK.
Yeah, there's that idea, isn't there, that somehow there's a double tax treaty, therefore there shouldn't be double tax. I can choose whether I pay it here or there.
Yes.
We get that so regularly, don't we? And it's like, and also just on that, which is always quite amusing, is that people somehow think that will be a defence. If HMRC come and say you owe us tax because you're a resident and you've earned this income, if you go, but Governor, I've paid it in Spain, Greece, wherever, they'll be like,
don't care.
That's not my problem.
And the other issue with taking that stance is usually, I mean, certainly in the UK, if you've overpaid taxes, you can only look back 4 years. So if you then leave it and, bury your head in the sand for 15 years and HMRC come knocking, the likelihood is that they're going to end up in that situation, or you'll end up in the situation in the other country.
Actually being double taxed.
Yeah, because you'll have run out of the time to go back and claim a refund of overpaid taxes in the other country.
So I guess the final piece of this that's worth talking about is America, because the US is a strange beast when it comes to taxation. In the sense, I heard once that there are only 3 countries in the world that tax their nationals, and it's America, Madagascar, and North Korea.
I'd heard Eritrea as well.
Well, there you go, right up there. And that creates some issues, doesn't it, in terms of, I guess, 2 things. One is the good old savings clause, which I'll let you explain. Yeah. And then 2 is the fact that we always tend to look at it and go, if I'm tax resident somewhere and I pay tax in another country because the tax treaty allows whatever that income is to be taxed, the country of residence will typically grant a tax credit for taxes suffered in the country of non-residence.
Yeah.
But in the US, it's a little bit different, isn't it? So let's start with the good old savings clause.
So the savings clause,
Article 1.4,
yeah, is basically says that subject to the provisions of a few particular clauses within.
Yeah, so like one of the pensions clauses, or 2 of the pensions clauses are allowed.
Yeah, there's a very small number of clauses where they will kind of follow the double tax treaty. But the starting point is that the US can tax its citizens and its residents basically as if the double tax treaty doesn't exist.
Which is a problem for US, and this is what causes the problem for US citizens living outside the US, is because that clause says that they can tax their residents or its citizens and its citizens.
Yes. And what the way that normally will take shape is that effectively you get taxed per the double tax treaty, and the UK will kind of follow that. And if taxing rights are given to the UK rather than to the US, then what that would actually mean is even if it was a source of income from outside of the UK, but the UK would have primary taxing rights on that income. And then once the UK has taxed it, then in the US, they're likely to tax everything to the extent that they can. And then they would allow a credit for the UK taxes. Yeah,
so you weirdly have this situation where people have to claim a tax credit even though they're not resident in the US because they're citizens of the US.
Yeah.
And that is one that we see got wrong so often, isn't it? We recently had a situation with US citizens who'd relocated from the US to retire in the Peak District, I think. And they had ended up claiming a tax credit in the UK for US taxes suffered, not realising that actually the UK was the one under the tax treaty that had the taxing rights. But then because it fell into the savings clause, the US were like, well, we're taxing it anyway. And actually the credit had to go back the other way. And it was a bit difficult, wasn't it? Because we ended up having to explain that they had I think it was like a £5,000 additional tax liability to get themselves properly set up.
And I think as well, I mean, this probably falls more within the US tax side of things, but I believe the US has a tendency to get tax credits on a cash basis rather than like in the UK where we'll match the tax to the income. So I think quite often...
They can have timing issues, can't it?
Yes, quite often with US linked people, they will tend to go down the lines of trying to make something happen between January and March and then make sure that their taxes are paid by December so it all fits within the same tax year I say in both countries, but from a US tax perspective.
Yeah, so again, the US is one always to be very careful of.
Yes.
And we spend a lot of time having those chats. I guess the way I quite like to finish it though is with a moment of brightness. And that's in relation to a client that we had a couple of years ago who was coming to the UK regularly to look after her mum. She herself was retired, and I think her mum was probably in her 90s. And she had got herself into a terrible stew about becoming UK tax resident and what that mean. All of her income was generated out of the US, wasn't it? And she got like pensions and savings and all the rest of it. And we were able to do the treaty analysis for her and work out that whatever she did, she was going to be treaty resident in the US. And it essentially gave her carte blanche to spend time with her mum, who was sort of moving towards sort of end of life.
Yeah.
And I have to say that from my perspective, so often we deal with people, like when it comes to like investigations and all that sort of stuff, where it's all a bit tense and people get quite stressed for obvious reasons. Being able to give someone that news that she could then spend time with her mum was really good, wasn't it? Because and it's nice to think the treaties can work that way to sort of sort people out.
Yeah, definitely.
So if you are looking at treaties, it is complicated. And again, as we said, everyone is different. Do get in touch with us here at LSR Partners. We spend a lot of time looking at treaties. That's how interesting we are. But at least you can benefit from it.
Thanks for listening to the Tax Compass podcast, brought to you by LSR Partners, where we help you pay the right tax in the right place at the right time. Book a call with us. Details are in the show notes.